Hi, this is Jack Crooks from Money and Markets TV. Back in November, I told you why I thought the US dollar was in the midst of a multi-year bull market. I've been repeating that forecast for months now, and this week we're seeing some technical confirmation of my bullish viewpoint as the dollar gets set for another major leg up. 6 months ago, I laid out 9 reasons why I thought the dollar may have bottomed. A change in credit crunch forces as U.S. savings began to go up, a flight from risk due to crisis in the Eurozone, growth in the U.S. relative to the stagnation or contraction in Europe, the U.K., and Japan, carry trade history based on the likelihood the European Central Bank would soon be cutting interest rates, the fact that U.S. assets are very cheap and enticing as foreign direct investment improves and some manufacturing comes back home. Sentiment, in other words, all the newsletter writers were telling us the dollar was doomed, and when they're so certain, they're almost always wrong. The negative correlation between the stock market and the dollar. If stocks break down, the dollar will rally. Technical indicators were showing upside momentum, and the strong possibility that the euro currency will crater, which will cause traders to rush into US dollars on their way to buying treasuries. Since then, the developments I've seen in the charts and in the European economy have only convinced me more that the greenback is in a very bullish position. For example, just this week the US dollar index broke above a key resistance level at 80.78, all but confirming that the next move will be another leg higher. Keep in mind, this index moves up as the euro moves down. So as the European debt crisis continues to get worse, I think that the dollar index will test the March 2009 high of 89.62. Eventually, I think the sovereign debt crisis will get so bad that the euro will sink to parity or 1-to-1 against the dollar. Even if it survives as a common currency, the region is already falling into another recession, and that economic weakness will certainly be reflected in the euro. There's also a tight negative correlation between the dollar and U.S. stocks, as you can see from this chart. I'm quite bearish on stocks over the next couple of years, and I expect this correlation to continue for a while. Overall, the global macroeconomic environment seems to be deteriorating. Economic growth is fading, global rebalancing is still playing out, and risk is rising. So despite our problems, our own problems here in the U.S., the dollar will win out in the end. I'm Jack Crooks for Money and Markets TV. Thanks for watching.